hear me now?
Yes, sir, I'm hearing, sir.
All right, okay. So we can start now. Last time we were on the management controls,
Yes,
and we came up to a particular point about the measurement
sir.
of various measurements. So we discussed, residual income and also return on investment.
Yes.
Right? So what is return on investment? It is basically when you say in a company or in a division, return on investment is 10%, what does it mean? When they say, for example, they say 10% is your return on investment. What is it telling us?
Return on capital employed, sir. Return from capital
Basically what
employed.
it says is for every $100 that you have invested, you are getting a return of $10.
Yes, sir.
That is what it means. So you must know, when an examiner talks about return on investment, it's all about for every, when they say percentage, 15%, that means for every $100 you have invested, you are getting a $15 return.
Okay, sir.
Now imagine there are two divisions, one get a 15%, one get a 18%. Who is better?
18% is better,
18% is better because he is using his assets more effectively, more efficiently to generate a return. Why we have assets in the business is to generate a return, isn't it? Not as a showcase, not for just for show purposes, but to make a return.
Okay, sir.
So for a company we don't call return on investment. For a company we call it return on capital employed. Inside a company there are many divisions. For divisions we have ROI. For the whole company we have a ROCE.
Okay, sir.
So that also we must know, right? Then the next one what we discussed is always when we were talking about return on investment or return on capital employed, remember it is profit before interest and taxes.
Okay, sir.
Another name for that is what? Operating profit.
Okay, sir.
Operating profit. That is sales minus cost of sales, gross profit, minus all your expenses before finance charges. That profit we compare with the capital employed. That is what we call for a company return on capital employed. For a division we call it return on investment. Another way to measure that is to take that profit before interest, right? Before interest and taxes, and from there we charge a notional interest. It's not an actual interest. It's a kind of a notional. It is not appearing in the books of financial statements, but it is a notional entry. We put it up to calculate the finance. So last time I told you a company, division may earn a bigger profit, but if they are employing a bigger asset base, their RI may be lower than the other company, other division.
Okay, sir.
Right? So you can see making a profit is one side. Making a profit with a minimum capital investment is another thing. You and I, we can make a big profit, but we might employ a very big capital. But that's not good. We must employ the minimum capital or the optimum capital and get the maximum profit. That's what a good company is.
Okay, sir.
So now we have another new thing which was developed by an American company called some management consultancy firm. The idea is what we call economic value added.
Okay, sir.
Anything that you know about that one, Kumar?
Which one, sir?
Economic value added.
Sir, I read, sir, but I forgot, sir.
Okay. So we are going to look at the economic value added. What is that? It's a kind of a you don't look at for a division the economic value added. You look at for the entire company as a whole or for a particular investment center, whatever. What you are trying to look at is what is the economic value that has been added during a particular period. So it is
Okay, sir.
simply, you know, our accounting profits are distorted in many sense.
Okay,
Right?
sir.
The way that we
Yes,
provide
sir.
depreciation, the way we provide
Uh-huh.
for bad debts can distort
Mhm.
the way accounting is prepared. The way we account
Okay.
for leased assets, there are many
Mhm.
options, choices available for us. So when you
Mhm.
prepare the same financial statements and when I prepare in the same company the financial statements, we might end up with two
Mhm.
profits. So basically, economic value added tries to remove all those distortions and they try to look at something called economic profit.
Okay, sir.
Economic profit is simply defined as net operating
Mhm.
profit after tax. So remember what is
Mhm.
operating profit? Operating profit is
Mhm.
before interest,
Interest and tax, yeah.
right? And before interest and before tax. When you say no
Yes,
PAT,
sir.
that means net operating profit after tax. It is before interest but after tax.
Okay, sir.
And that's a bit of
Okay, sir.
a tricky one because in our
Okay.
P&L what we have is profit before interest,
Mhm.
then we have profit
Mhm.
before tax and interest, then we have
Okay.
profit
Mhm.
after tax. We don't have an item called net
Mhm.
operating profit after tax. When you say net profit
Okay, sir.
operating profit after tax, it is before interest but after tax.
Okay, sir.
So
Okay, sir.
you have to do a little bit of a calculation because tax is
Yes,
deducted
sir.
for interest is deducted for tax purposes. We have to add
Yes,
that
sir.
interest net of tax to our
Okay, sir.
profit and then arrive
Yeah.
at net operating profit
Okay.
after tax
Yes,
minus
sir.
what we call a
Mhm.
capital charge. Now, capital
Okay,
charge
sir.
is based on your economic value of business. You remember we were talking about RI. In the RI,
Yes, sir.
we were basing that charge on the total assets.
Uh-huh.
But here
Okay, sir.
we don't look at the total
Mhm.
assets. You know what's the problem? Total assets. Now, for example,
Mhm.
you and I, both of
Mhm.
us buy for two vehicles for the same for two
Mhm.
different businesses, but we are in the identical business, right? You will
Okay, sir.
charge you will think the life period of the vehicle is 5 years. So you
Okay,
will
sir.
depreciate it over a period of 5 years.
5 years, yeah.
So after 5 years, the vehicle does not have a book value.
Yep.
I depreciate, I think my vehicle is going to remain for 10 years. No one can challenge.
Okay, sir.
No one can challenge
Yeah.
because that is your estimate, this is my estimate. So after 5
Okay,
years,
sir.
I will still have a 50% value of the asset.
Uh-huh. Yes,
So
sir.
if you go by the residual value of asset or the asset value, you will have a different
Mhm.
figure, I will have a
Mhm.
different figure.
Different. Yes.
Now to avoid that one or to get over that one, we look at what we call economic value of business. When you say economic
Okay, sir.
value, we ignore the depreciation what we have provided. We look at the
Mhm.
economic value of the vehicle. Now that
Yes, sir.
one, whether it is for you or for me, after 5 years it will be
Mhm.
the same.
Okay, sir.
Right? So we will look at certain like market value or replacement value or something, and therefore
Okay,
it
sir.
is basically
Mhm.
it's a much more better one than the accounting kind of
Yeah.
notional interest. So what are the
Okay.
differences between economic value and residual income? You can see almost same, right? Residual
Mhm.
income, accounting profit minus notional interest. If
Okay, sir.
economic value added is net profit, net operating profit after tax minus
Mhm.
capital charge. Now I
Yes, sir.
want you to note down the differences. The first one in the residual
Okay.
income, we use the accounting profit
Okay, sir.
and we use the accounting value of capital employed.
Yes, sir.
In the economic value added, we use the estimated value of economic profit and also we
Okay, sir.
use the economic value of capital employed.
Oh, sir.
This is what we need to know, right? The
Okay,
examiner
sir.
there may be little calculation questions we will look at when we are answering the question, but I want you to
Okay, sir.
know about these things. And before I forget,
Okay.
now since we are not going to do the risk management, since you have
Yes,
studied,
sir.
I'm going to send you some
Okay, sir.
questions maybe after today, which I want
Okay,
you
sir.
to on the risk management,
Okay, sir. Okay, sir.
right? because I want you to understand, because ultimately the paper is all about risk management.
Okay,
So
sir.
it's good. I
Okay,
mean, it's
sir.
good for you to do self-studies, but we
Yes,
must
sir.
know whether
Okay,
we
sir.
know enough to answer the paper.
Okay, sir. Okay, sir.
Because bulk of 20% or 40% of your questions are on the risk management.
Yes, sir. Okay, sir.
So let's look at our traditional management accounting systems. So this is what we have with the age-old accounting systems. What is it? Standard costing,
Okay.
right?
Yeah.
Standard costing. We
Yeah.
have a standard cost, and based on that we prepare budgets and we prepare actuals, and then we work out what we call variance analysis.
Yes, sir.
And under traditional method, we used to allocate overheads or apportion overheads mostly based on three methods. Can you remember the methods?
Okay.
Labor hours.
Yes.
What are the other
Okay,
ones? Labor hours, machine hours. Labor hours, machine hours are basically the two methods what we use mostly to apportion the overheads. That was the traditional method. In fact, we still use it. Then,
Okay, sir.
whenever we want to see whether a new project is good or bad, what do? We do what we call NPV appraisal.
Okay, sir.
If the project is positive NPV, we say yes, right? And
Yes.
then
Yeah.
in P2, you
Internal
learn something called transfer pricing. That is basically,
Okay, sir.
we internally we decide either way, whether it is forced or whether it is negotiated or whatever, a transfer pricing
sir.
to internally make the price. And also, traditionally, we were rewarding the people based on performance based on their financial performance. So I told you now things are changing. Standard costing is no longer a kind of a technique we use it. Not that we don't use it, but it's going out of style, out of pace.
Yeah.
You know why? Because with the standard costing, what happened was we had a standard. We were set to achieve the standard. So long as we get the standard, so long as we get that cost, everything is all right. But today we live in a world what we call in a modern business world, in a modern business environment. You can't wait with the standards, because every day some person will come to the market and introduce a new product, and you can't be keeping to the standard. Customer has lot of bigger choices. So it's a matter of now something what we call continuous improvement. You don't wait on the standard, you try to improve on your standard, improve on your costing, improve on your cost figures, etc. You try to go and do all that kind of a thing. Can you remember the name that we give for that kind of continuous improvement? It's a Japanese technique, not activity-based, right? It's a kind of a continuous improvement what we do all the time in business. Now we don't wait for, we are not happy with the standard. We want to continuously improve. So one way what we do is we use something called total quality management.
Okay, sir.
Total quality management. But in the total quality management, one of the concepts is continuous improvement. And that is what we call, you remember, Kaizen approach. K-E-I-Z-E-N. Continuous improvement. Right? That's the way that new businesses, the way that we develop today. So in your case study, it is, you can't go by the old standards. The old standards are very old. People don't wait for the standard. People can't just wait within the standard, because some competitor will produce a better product, and therefore you have to continuously think of making improvements to your product. Overhead allocation, earlier we did on labor hours, we did on machine hours, but now we do it on another way. And that is what you just now told. What's that?
Yes, activity-based costing. Yeah.
Activity-based costing. Activity-based costing. What does that mean?
Yes.
What is it, that one, Jaykumar?
So allocation of expenses based on the activities, sir.
Activities, and what drives the activity, which we call cost driver.
Okay, sir.
right?
Yes, sir.
Earlier
Cost
we
savings.
thought all
Yep.
the overheads are moving based on the machine hours or labor hours. But we know that's
Yes,
not
sir.
true because the rent won't move with
Yes,
the
sir.
machine hours, rent won't move with the labor hours. So because of that,
Okay,
now
sir.
we try to go on the basis of activity
Activity.
and the cost driver, which is driving the activity. So we are not looking at a
Okay, sir.
particular machine or a particular overhead.
Okay,
We try to look at the overhead put into a pool, what we call a cost
okay,
pool, which comprises
okay, sir.
many things. One activity, it may be to raise the invoice. What are the
Okay,
activities
sir.
that go? So all
Okay, sir.
the cost that goes to raise an invoice, we put it into that
Mm-hmm.
cost pool, and then we see,
Okay,
okay,
sir.
maybe the
Mm-hmm.
with the more number of invoices, the cost is increasing. Then we will take the number of invoices as the cost driver, and then we will work out the cost per invoice.
Okay, sir. Mm-hmm. Yeah.
Why do we have to do that kind of thing, Jay Kumar? Why do we have to change from our overhead earlier thing to new this
Okay.
activity based costing? Not that everyone has changed,
So,
but some have changed.
uh-huh.
Why?
Yes,
What's the
no,
reason?
sir.
What's the reason why
No,
the
no, sir.
people have changed? Why the people have changed is for one simple
Uh-huh.
reason. Earlier,
Uh-huh.
40, 50,
Uh-huh.
60, 70, 80 years back, most of the production was based on machines and
Okay,
labor.
sir.
But
Okay,
today,
sir.
most of the goods and
Uh-huh.
services are produced through most of
Uh-huh.
the things by use of computers and all the other things.
Okay.
So the
Okay,
more
sir.
overheads are much more today than the earlier
Mm-hmm.
days. Lot of
Okay, sir.
overheads. So if you
Okay, sir.
just go and wrongly allocate the overheads on a wrong arbitrary basis like machine hours or labor hours, you might get wrong product costing.
Okay, sir.
And if you get the wrong product costing, you might do wrong selling price. Because based on cost
Yes.
only, most of the time we put the selling price. And you might find no sales happening because your products are overcosted, or you might find more
Okay,
sales
sir.
happening, but you may not have a
Mm-hmm.
profit because you have undercosted. So that's a
Okay, sir.
danger, right?
Okay,
So
sir.
when the overheads are more, you can't do that arbitrary kind of costing. So what you do
Okay,
is
sir.
you go and do a better kind of a allocation of costing, and that's what we do with activity-based costing. Now, activity-based costing, you know, it's a very, very costly process. You have to
Yes.
identify all the activities, cost drivers. Of course, the computers are there today, but it's a very, very costly process. So where is it is
Okay,
ideal to apply activity-based costing?
sir.
Where is it ideal to apply activity-based costing? Let me put the question like this. There is one company with little overheads, another company with big overheads. Where is it more appropriate to apply the activity-based costing?
The company which having more overheads, sir.
Company which having more overheads. Because if you don't do the right thing, you have a big expenditure, and if you do wrongly allocate it, your costing can be very erratic, erroneous.
Yes.
In a small overhead component, even if you make an error, it's not going to be a big error.
Okay, sir.
So I was working in a company, small company, where we had only 6 people, and my managing director went for some seminar, and she came and said, Kumar, why don't we introduce activity-based costing? I asked, what? Then she said, I learned activity-based costing, why do? I said, why? Because here we have only a small setup, small overheads, we know the cost. So we can easily allocate the cost straight away to the product or the service. Why do we want to do a unnecessary complicated thing? In business, we should never do unnecessary complicated things unless it is for a purpose. So the new method is basically what we do is all what we call the activity-based costing. Investment
Okay, sir.
appraisal still we do with the same old methods, but we
Okay, sir.
look at some other things also. We look at the non-financial things through the balance scorecard. Because
Okay.
sometimes the investment appraisal may show a minus figure. But we don't stop there. We might do it still because it might bring some better benefits for the future. or it may be a legal requirement that we have to do it, and therefore we will continue to do it.
Okay, sir.
Transfer pricing we still do, but more on a more negotiated, more kind of a flexible approach rather than being imposed from the head office. Rewards and
Okay, sir.
appraisals, we go not only on the financials, but we go on mostly on the financials plus non-financial.
Okay, sir.
So basically the criticisms of traditional management accounting system what we just discussed, it is too formal and it produces very routine report. Every month you get a variance analysis, every month you get the cost report. No one is very interested even in looking at those reports.
Okay,
Sometimes the assumptions that we have made are very, very questionable. Right? We apportion the rent on the basis of machine hours. And the
Okay,
people can argue, how can the rent move with the machine hours? Right? And very cumbersome with things like budgets. Right? And many look cost as a production cost, whereas most they are overheads. Because when you apply, when you put the overheads into the production cost, everything is going as production cost. But we realize bulk of the thing is production overhead. So last time in the case study, I think it was all about in the strategic case study. It was about reality TV production company. This case study, they had a big overhead cost.
Okay,
And
sir.
because they were not paying too much for the cost and all that, they were a big overhead cost. So we had to be careful.
Okay.
And generally, it tends to focus on low cost, ignoring business strategy that wants to go for quality. Now, this is the today business modern world, where we call total quality management. Quality is more important than cost.
Okay, sir.
Our time, it was not the quality, it was cost, all the time cost. Keep the cost to the budget, keep the cost to the standard. But today, people will go beyond that one because people are looking for quality products. When you go to the market, you don't buy the lowest price product, you go for quality. So the quality has become very important, and therefore the business must focus on quality. We have something called beyond budgeting. Anything that you know about this one?
Do not know, sir.
Right.
But I studied this in P2, I think.
Okay, yeah, I think in P2, yes, it was there. What is beyond budgeting? Basically, what does the budget do? When you are given a budget, what is it doing? It restricts your vision. It restricts your activity. You are told you have to work within the budget. Isn't it?
Okay, sir.
Right? You are told to you have to work within the budget. So when you have that kind of a budget, a kind of a thing, it limits your capacity. It limits your thinking power. It limits your planning. So the present modern world is what we call empowerment. Empowerment. We want to empower people. Earlier, it was the top management deciding, the lower level people just carrying out those duties. And for every little thing, they have to run to the board of directors to get special approval. But today, you can see in any company, at the lower level, people can take decisions.
Okay, sir.
So the idea was, it's not really to abolish the budget, but to, go beyond the budget. Give a kind of a opening. Don't stick to the budget. If you find something coming up very well, try to accommodate that one, even though you may not have a budget. Because the budget is a kind of a commitment. Basically told you have to stay within the budget, and it constrains from doing something beyond that one. And generally the budgets are top to down, even though we call it's a participatory budget. Ultimately the decisions are at the very top level. So there is very little empowerment. Today the younger generation managers, they don't like things being imposed upon them. Even the children don't like it, right? They want much more freedom, right? Our time when our parents say something, don't come after 6 o'clock, we don't, right? But today it's not that one. Even in the business world, it's the same story. People, the young SEMA accountants who are joining the business world, they don't want to take instructions and just to carry the instruction. They want to be more innovative. That is how we have been taught now. Right? We want to go beyond and to think something new and to do something new. That is why there is something called learning and innovation. That is why SIMA is talking about continuous professional development. We never end up. I have a lot of my friends who did their exams in 1980s. They are completely outdated. They have the 4 letters behind them, but they can't do anything nowadays, today's world. They are completely outdated. But thanks to the coaching that I do with the students, I have been able to keep up with all what is happening in the present world.
Okay, sir.
So when you have a budget, your flexibility restricted. And therefore, you can't do continuous improvement. You just have to produce that the standard cost, standard product, and wait. So the total quality management says continuous improvement. So when you have a budget, you can't go for continuous improvement. And generally you work, when you have budgets, you work in what we call divisionalized compartment. You don't want even to share your knowledge because you are competing with your other department. Right? So your boss will say, hey, Jay Kumar, don't go and tell those people what we are doing. Inside the company, same family, but we want to be separated because we are fighting for our bonus. So there is no knowledge sharing. But today the modern world is to share the knowledge. So generally when you have a budget, it's a very bureaucratic thing. Right? Surely, you know, in India, it happens in a very traditional way. Lot of bureaucracy, everything set standards, set guidelines, set circulars, everything need to be done that way. And very much internally focused. You are like a frog in the well. You don't know what's happening because you are thinking of all the time your budget, your cost, your standard.
Okay, sir.
Without realizing that some fellow has produced a better product and has come to the market and has taken your share. Because you are always internally focused. And lot of time is spent on that kind of a thing. So to get away from that one, there is something called the beyond budgeting. That is to empower people to go and think beyond the budget.
Okay, sir.
Justify their new project, the management is prepared to accept it. Listen to it.
Okay, sir.
So, if you look at the modern and traditional manufacturing methods, you can see in the traditional manufacturing methods, we had standard products, we had long production runs, we produce the same product for long periods of time, right? Quality is something which is acceptable. If you can meet that quality, that's enough. Don't try to improve anything. Don't try to overdo things. Very slow product development. Because you are not going for innovations, you are not going for any new thing. So nothing new product development. This was the story, right, I think up to 1970s, 80s in the world. But if you look at today, and see what the generation, it's a globalization. Right? You are not confined to one country, you are selling all over, particularly with the websites.
Okay, sir.
Particularly the websites, you are selling, I'm selling my SIMA all over the world.
Okay,
just prepare a Facebook page and put it, I want to sell it all over the world, my SIMA knowledge. I'm not restricting it to a particular country or a particular group. Right? Competition. Very severe competition. Very severe competition. If I don't give you tuition, you can go to another place. And we have this concept of what we call just-in-time and total quality management. What is just-in-time?
So just-in-time is it's produce or buy the products as when the customer is required. Sir.
That's a good one. That's a very good one. I'm happy about that one. Yeah, it's not we producing, keeping zero inventory. It is a question of producing when the customer wants.
Yeah.
And from there backwards, we will see we will not produce and keep it, and therefore we will not buy and keep raw material. It's not a question of we not buying raw materials and keeping zero raw material. It is a question of keeping zero finished goods. We produce only when the customer wants. Right? And total quality management, as I said, the three words, total means everyone in the organization is concerned about quality.
Yes, sir.
Everyone, not only the quality control department, not all the quality inspectors, from the garbage cleaner to the CEO is worried about, concerned about quality, how it can be improved. Quality means not what you think as a set standard. Quality means what the customer wants.
Okay, sir.
What the customer wants. Management means managing at every level the quality. You don't wait till the product is produced. At every stage, the quality is managed. Through quality circles, quality chains, it is managed. And today we live in a world where we use mostly what we call intelligent machines or computers to do most of the work. Look at your CIMA exam, right? Immediately after you sit for the exam, the computer will say whether you have passed the exam or not. Computer is fed everything to look at your answers and to see whether you have got through the exam or not. Intelligent machine. When we apply for visa, it is the computer who will decide whether to give visa or not. When we apply for a bank loan, it is the computer that will decide whether to give a bank loan or not.
Okay, sir.
Just in time, as you rightly said, it is this is a very important slide which I'm doing now. This is basically a slide that most of the questions are. To have a JIT environment, you must have a stable volume of demand. If the demands are fluctuating, we can't have a JIT. Because just because you are JIT, your suppliers are not, prepared to supply today 500,000, tomorrow 10,000 kind of a thing. You must have a very stable kind of a demand. Then the JIT can be applied.
Okay, sir.
You must have a continuous coordination with your supplier and your customer.
Yes.
Right? And because you are just in time, you have to have very reliable suppliers. So you have to select your supplier. Even at a higher price, you must buy from reliable suppliers. And you must have a very suitably laid factory layout. What do you mean? Right? You can't have your production one part here and another part 20 kilometers away. Because, if something happens in that factory, you are producing and there will be a big overflow or a bottleneck. Right? So you have to have your factory layout in a very visible form. The people who are at this end of the factory will see that other end something is going wrong. And they will run and try to correct it, because otherwise what they produce is useless. So that is why we have what we call red light systems, yellow light systems, green light systems. The man at this corner can see there's a red light flashing at the other corner. Then he knows, hey, they are in a machine problem. So therefore, stop here. Otherwise, there will be a heavy outflow without a proper kind of a absorption power to do it. So it can have a big barrier. Right? So reliable transport system, because you are supplying just in time. So therefore, you must have very good air transport, shipping, etc., even road transport, so that you can carry goods just in time for the port. You produce at 9 o'clock in the night, you produce 11:15, it must be in the ship. So your road system, rail system should be super. You can't have traffic blocks and all that kind of a thing if you are going to have a JIT system. JIT philosophy, if you look at it, is basically you are working on the elimination of waste. You don't overproduce things and keep, because that's a waste of money. That's going to increase your capital, and that is going to reduce your ROI. That is going to reduce your RI, right? You don't want to have any non-productive time, because all the time you are producing, and you don't want to have any inventory. Inventory is a very costly thing. It blocks your money. It can end up with obsolete inventory. It can end up with pilferage. So by working to JIT, you are not going to have inventory, and that way you can manage your inventory very well. setup reductions.
Okay.
Setup reduction, because you have to change
Okay.
all the time the setups. You can't do one mass scale production because your customer A's production may be something, customer B's production is another thing, customer C's production is another thing. So you have to go on setting up all the time. So the setup time should be reduced as quickly as possible. Machine should be changed, set up, and go and produce it. And of course, continuous improvement. This is another way to get people to get energized for multitask, right? You are not only learning to operate the machine A. If you find the machine C is not working well, or there is no machine operating machine C, you can go and operate the machine C. You are trained on multitask. What is strategic management accounting? Now you saw the new management accounting, what we did. So what we realized was it's not very internally focused. It is looking very much external.
Okay.
Right? So you have to look at for external factors. So you have to see how to get that competitive advantage. You remember in our first lesson, we learned how to get the competitive advantage. How do you get? By taking risk.
Yes, sir.
By taking risk. And also you must look at long-term planning. Long-term planning with short-term planning must get coordinated or linked up. So strategic management accounting, as I said, it is somewhat externally focused, and therefore it is very much concerned. You remember I told you, with your two eyes, you are going to look at two people, customer and competitor. Customer and competitor. So your management accounting is very well concerned with collecting information about competitor. What are they doing? You have to be very cost effective in a competitive world. So we have to see what are the opportunities or ways and means to reduce the cost. And matching the emphasis of accounting on firm strategy. So our accounting is not very traditional things like variance analysis, etc. We must be producing ad hoc reports to meet the requirements of the board of directors for them to make on strategic decisions. So that is why in our case study, you being a senior manager, senior accountant, will be providing many ad hoc reports. It may be about the environmental, it may be about your corporate social responsibility. So you are not preparing standard reports, you are preparing different reports according to their needs on the firm strategy. This is a very important one. Lean organization. What is lean organization? It is simply cutting waste and unnecessary activity. We try to see what is going to call value adding activity and non-value adding activity.
Okay, sir.
If you look at through an organization very carefully, you might find certain activities are just there for the sake of it being there. Look at these old stenographers what we had. Now, do we need stenographers now?
Not required, sir.
Not necessary, isn't it? Because we do most of our communication through emails. Yeah, through email. We don't get that stenographer and dictate a letter. We don't do that kind of a thing. It's all emails, right? We do it by ourselves. Remember in some of those companies earlier, we had this big postal department. Inward letters, outward letters. Right? All the letters are coming through the postal section. So there's a big clerk with a big table trying to sort out. But today nothing. Because all the letters are emails. All the reports are emails. So you don't need this kind of people. So you can remove, if you really go with a fine comb, you might find that you can remove lot of what we call fat from our organization. To do that, we use two elements. One what we call total quality management and the other one what we call just in time.
Okay, sir.
through the concept of just-in-time, we remove the warehouses, we remove the storekeepers, we remove the stores accounting, all that kind of a thing. You don't need it.
Yes, sir.
Look at the eBay. They sell the biggest millions and billions of dollars sales. But do they have a warehouse? No. They only have a virtual warehouse. They just have advertised things on the website. When the people order, they will contact the supplier and tell the supplier, hey, Kumar has ordered a book, send it to him. That's all. But they're a big organization, $1 million, billion business. Completely the fact is removed.
Yes, sir.
Yeah. Total quality management. There is no need for a special quality control department. Quality inspectors. Everyone is concerned about the quality. There's a voluntary set of people who are called quality circles who will be looking at the quality. So basically, the lean management accounting system provides information on the value that is being added. It's not about the how much the finance department is costing, how much HR department is costing. No, we are not interested. How much value has the finance added? So that's what the lean accounting is going to give. So it is going to provide information on continuous improvement and what we call target costing. Now, can you remember what is target costing? Would I learn it in P2?
Yeah, first we will fix the price, sir. From that we will subtract our profit. Based on the remaining cost, we will work it on. Work out on it.
Actually, not that we can fix a selling price. The selling price is decided by the market because we are living in a competitive world, right? We can't set the selling price. Earlier we were setting the selling price. Taking our cost $100, we had a 20% markup and we set the selling price 120. But today we can't do. If we do it 120, no one will buy because the market price is 110. So because of that, we have to take the market price and decide what we want as a profit margin. Okay, we want 20, then our target cost should be 9. That's what we do. That's what a lean organization is doing. We try to get that 90. How do we get it at 90? Imagine the cost works out to 95. What will we do? When you work out the cost, it comes to 95. You work out and tell your management, hey, the cost is 95. But the target cost is 90.
Okay, sir.
What are we going to do? What are we supposed to do? We must do something called value analysis. You remember? Value analysis.
Yeah.
You look at that cost structure 95 and see what cost can be removed without compromising the quality of the product, without having an impact on the usefulness of the product.
Okay, sir.
Right? And see whether we can remove. I remember I was working, when I joined as a young man, my managing director told me, we had a garments factory manufacturing shirts. He told me that that company was making losses. He told me, you better go and sit in that factory and see what are they doing. See whether you can cut down on cost because the cost was too heavy. They were supplying to the American market. The price was fixed. They could not do anything with the price, but they had to see if they want to make a profit, they have to reduce the cost. So I just went and sat there and waited. And what I realized was they were putting something like 7 buttons on the shirt.
Okay, sir.
So then I asked one of those workers, why are you putting 7 buttons? Can't you put 6 buttons? Right? Because you only have to increase the space between 2 buttons and make it with 7. When you do with 7, when you do with 6, you save 1 button.
Yes, sir.
They were putting 16 safety pins to tag the shirt. I said, why? Why do you want 16? Remove some of those things. Because the person who is going to buy the shirt is not going to count the buttons, is not going to count the number of safety pins. He wants to see whether the material is good, whether his body is covered up, right? Whether the cutting is all right. Those are the things what he is looking at, isn't it?
Okay, sir.
Remove all those unnecessary costs. That is what a value analysis will do.
Okay, sir.
Can you remember the matchboxes those days? The matchbox had
Yes,
chemicals on both sides of the matchbox.
yes, sir.
Both sides of the matchbox. The chemicals so that you can strike the match on either side of the box. But if you look at
Yes,
today
sir.
the matchbox, they have only one side.
Mhm.
Right?
Okay, sir.
Some person said, why do you want to have chemicals on two sides?
Mhm.
Because you're going to strike the match only on the one side. You're not going to strike it on this side and other side. So
Okay, sir.
when you remove that one, what is the savings on chemical cost? 50%.
Yes, sir.
50%. That can make a big difference in your costing.
Yes,
This
sir.
is what we call value analysis. What's the
Okay, sir.
difference between value analysis and functional analysis?
Sir.
What's a functional analysis? Value analysis, we look at the cost of the product from
Yes, sir.
different items. Functional
Okay,
analysis
sir.
means we look at the functions of each the company, different functions,
Okay, sir.
and see can we remove this
Okay.
function without affecting the quality of the product we are going to do.
Okay, sir.
Can we remove our customer complaint unit? Can we remove our receptionist? Look at the banks, what
Mhm.
have they done? Right? They have
Yes, sir.
introduced this automated telephone internet banking facility. What have they done?
Yes, sir.
They have basically gone into little small banking offices. Not so
Yes, sir.
many tellers are required. Now when you go to the
Yes, sir.
bank, even deposits, you can deposit the checks on the box, come back,
Yes.
isn't it?
Yeah.
Hmm? So
Yes, sir.
you don't need any of those big things now.
Yes, sir.
So this is what we call a functional analysis.
Okay, sir.
And always when you're applying the target costing, we look at what
Mhm.
we call life cycle cost of the product. Now remember the life
Yes, sir.
cycle? 4
Yes,
stages?
sir. Yes, sir.
Yeah?
Yep.
What are the 4 stages of a life cycle of a product?
It's like introduction stage, sir.
Hmm?
Growth and development and growth.
Yes?
Sorry, growth and
Growth, introduction, growth, yes?
then
Then maturity, mature, isn't it? Stable.
yes, maturity and declining, sir.
Maturity and decline, yes. Introduction, growth, maturity and decline. Now at
Decline.
introductory
Yes, sir.
stage, what do you think the cost per unit? Will it be high or low?
It will be high, sir,
High. Why?
because we have to spend more this promotional cost will be
Exactly.
there, sir.
More promotion and even your product is still under learning, so there will be a lot of mistakes, etc. So introductory stage, the
Yes.
cost is always very high. What
Yep.
happens during
Yes,
the
sir.
learning stage? The growth stage.
So the growth stage, our production cost will decrease, sir.
Why? Yes, good. Why?
Yeah, because we will the laborers will be more experienced in making the products and
Yeah, what is that called?
demand.
Labor is more experience and producing product. We call it something. P2,
Yes,
you
sir.
learned
Yeah,
it.
that is.
Learning curve.
Yes, sir.
Learning curve,
Yeah,
isn't
yeah,
it?
yeah, yeah.
Learning curve.
Yep, yep.
Right? You must use these
Yes,
terms.
sir.
When you're answering, you must use these terms. Learning curve.
Okay, sir.
Right? So
Yes, sir.
during this period, the learning curve will apply and that will reduce your
Okay.
cost.
Yes, sir.
Right? And also, by that time the
Mhm.
product is launched and therefore there is economies of scale because you are producing
Okay.
bulk and you can get bulk quantity discounts, etc., etc.
Yes, sir.
Then we go through what we call a stable period. Stable
Okay,
means
sir.
the
Mhm.
everything is very stable. You don't spend too much now. It's basically the cost has come down and it will remain
Yes.
somewhat stable.
Yeah.
Then decline period. Decline period, what happens to cost?
Cost will be more, sir.
Why? Good.
Cost will be more because of
Why? Cost is more. Yes, you're right. Why it is
yes,
more?
sir.
It is more
We have
because the people have learned. and learned enough.
Yeah.
Now it is boring for them. They
Yeah,
don't
yeah.
learn anything now. It's very boring for
Okay.
them after some time.
Okay.
So their efficiency drops.
Yeah.
And also your machines are very old, giving trouble.
Yeah.
So
Yeah.
the
Yeah.
cost will start going up. And that is why we say it's a decline stage. We want to get rid of the product.
Okay.
Right? We
Yeah.
want to introduce a new product at that time. So when
Okay,
we are
sir.
taking target cost, we don't look at that introductory cost and set the target. We don't look at
Okay, sir.
that growth stage and look at the target. We look at the
Yes.
overall life cycle cost, take the average
Okay,
cost
sir.
and set the target.
Okay, sir.
That is what we do. And today we
Okay, sir.
see in most of the products, what do you think the life cycle? Is it very long or too short?
Okay, sir.
Today, what do you think? A product that is
So,
introduced into the
life
market, do
cycle
we
is
have a
very
long life
short,
cycle or a short life cycle?
short life cycle, sir.
Short life cycle. Because
That year.
because of the technology, because of the speed of communication, everything, competition, new products are being
Yeah.
introduced, new developments are happening, and therefore our
Yeah.
products have a very, very short life cycle. Look at the mobile
Okay, sir.
phones, maybe 6 months,
Yeah.
a new product comes up,
Okay.
and the earlier product goes out
Okay.
of market. Right?
Okay, sir.
So because of that, we have to be, this is where even our NPV analysis is very questionable. Can we do a forecast for 5 years? We never know whether our product
Yeah.
will stay in the shelf for 5 years.
Okay, sir.
So because of that, we need to have very simple, easy, accessible information to eliminate non-value added information.
Okay.
This is what we should be looking all the time.
Okay.
What are the problems with modern management accounting?
Okay.
Problems with modern management accounting is because of the JIT, some of the big companies, the big multinational companies, they can hold their suppliers to ransom, asking them to give priority for them and giving them low prices, which is not very ethical, which is not acceptable, but this can happen because you are a big customer, big supplier, your big customer, your small suppliers will have to rely on you, and therefore they can dictate, don't give it to Kumar, give it to me, your entire.
Okay, sir.
So that kind of a thing.
Okay.
TQM, even though theory it says continuous improvement, it's not something which we can achieve all the time. Right? It's not something that we can achieve all the time. Then finally we have the balance scorecard. Now this is a very important examiner's question. Most of the time it's a practical problem. It's good to have 4 perspectives. What are the 4 perspectives? Customer, internal business,
Customer.
learning and innovation, financial. But imagine if you are being tested on 4 key performance indicators when you are doing your lectures as an accountancy lecturer in your Oman business school.
Difficult, sir.
Very difficult, isn't it? Very confusing. You are now thinking,
Yeah.
should I reduce my time and be bothered about quality, or should I be giving more time to my students, improving their customer satisfaction? Also, I must look at how to train my lower lecturers, and also I have to look at how to improve my product. So when you are measured on 4 measures, it's very confusing. If we were told that you are measured on number of student successes, much easy.
Yes, sir.
Much easy. But we have been told, bothered about the quality, bothered about the quantity, and also see that new products, new programs, new material is being produced. It's a very, very confusing thing. So these are some of the problems that we face with the modern management techniques. Even though they are good, we have problems. So we just have finished up one big area, what we call the management control. Right?
Yes, sir.
Also, what I would like for you to consider, I think I sent you the BPP textbook. Do you have the Kaplan with you?
Yes, sir.
You have the Kaplan textbook. Kaplan textbook have you got?
No, BPP you sent, sir.
Yeah, BPP textbook you have. I want you to go through the
Yes.
management control systems in that
Okay, sir.
area, and I also want to
Okay, sir.
look at the
Uh,
we discussed the behavioral implications all that. I want you to look
yes.
at very specially the
Okay.
different organizational structure.
Okay, sir.
You remember there are mainly 4 different organizational structures. Number 1,
Okay, sir.
functional.
Yeah.
Number 2,
Yeah.
divisional.
D-
Number
Yes, sir.
3, matrix.
Mhm.
Number 4,
Yeah.
what we call network.
Okay, sir.
So, what is a
Okay,
functional
sir.
structure?
Sir,
Yeah,
based on functions, sir, that like finance, marketing, production, like that, sir.
yeah. Basically, your organization is structured on a functional basis.
Function.
What are the
Yes, sir. Yes.
advantages? What are the disadvantages?
Sir, advantages,
Mm-hmm.
when you go for functional, sir,
Mm-hmm.
then it will create dysfunctional thing will come, sir.
Yeah.
They will concentrate only their own
Yeah. Look at the advantages. Look at the advantages of functional. Very clear.
specialization. Yeah.
Specialization. Okay, very good. Yes.
Yes.
And very clear
Then
lines of responsibility, isn't it?
yes, sir. Yes, sir.
Very clear lines of responsibility. You know who is your boss and you have to work under
Yes.
his instructions, and all that
Yes,
is
sir.
very clear. Budgets can be prepared, all that can be done. The disadvantages is what you just now told me. If there can be lot of miscommunication, dysfunctional behavior, because you are competing with another function and therefore you are not going to share your knowledge. All that can be ultimate from the organization's point of view. It can be somewhat
Yes.
dysfunction.
Yes.
What is a divisional structure?
Sir,
What's a divisional structure?
based on the divisions, sir.
Yeah. What do you mean?
Yeah.
What do you mean when you say division?
Division.
Division is basically, and for each division, you probably have different functions also.
Okay, sir.
Right? You might have a division. Within the division, you have your function. Within the division, you might have a finance function.
Okay, sir.
Right? It is maybe regionalized. Maybe Indian operation, maybe the Middle East operation, maybe the American operation.
Okay.
Each operation will have its own financial functions, HR functions, etc., etc. That's what we call a
Okay,
divisional function.
yes.
Obviously, it has very little confusion, but it can be a big
Okay.
duplication of work. You might have many finance people, many HR people, and there can be also lack of consistency.
Okay.
One will work in one way, the other will work in another way, all that. What's a matrix structure?
Mm-hmm.
What's a
That's
matrix
I read
structure?
everything. Yes, sir. Yes, sir. Forgot, sir.
Yes?
Yeah, I forgot. I've both gone through everything, sir, but I forgot. Long back.
Yeah. Matrix structure is basically for the project management kind of a thing, right? You have your
Okay, sir.
functional things. You take one person, you take from support from the accounts department, you take support from the HR department, you get into a project and try to work through a project.
Okay, sir.
That's what we call a matrix structure. Ideally good for project-based organizations, but we have a problem there because you will be under 2 bosses.
Okay, sir.
You will be under 2 bosses. You will have the project manager to whom you are going to report, and also to your own finance director whom you are going to report. So you have to take the instructions
Yes,
from 2 people. It can be very, very confusing, and it can create lot of confusion. But the work will happen very fast because you are project oriented, you are custom oriented. This is why you find in the banks what we call priority customers. The customer don't need to go to each and every section of the bank. He has one person. You contact that one person. That one person will get everything done for you.
Okay, sir.
So that's
I will
what.
go through again this one.
Yeah. Go through the organizational structure because they are very important ones. Whenever we think of strategic changes, we must think of various organizational structures, what we need to do.
Okay, sir.
Right. So that's all right. So we are going to look at internal controls is our next
Okay.
topic, but we will look at
Okay.
when? Friday. How are you? Today is Monday.
Yes, sir.
Friday is holiday for
Yes,
you,
sir.
no?
Yes, sir. Yes, sir.
So Friday shall we do?
Yeah, okay, sir.
Hmm.
So I
So
need that question. You told me some questions you will send like that, sir.
I will send you the questions now. I have finished the management controls. I finished because we did risk management also. So I send you some questions.
Okay,
So
sir.
you have Tuesday, Wednesday, Thursday to work on some of those questions.
Okay,
And
okay, sir.
yeah, Friday shall we make it same time 5:30?
Friday at 5:30, sir.
Yeah.
Okay, sir.
Okay. So we'll make it on Friday 3rd of March 5:30.
Okay, sir. Okay, sir.
I'll send you some questions. I'll send you these
Okay,
slides
sir.
also for you to go through,
Okay, sir.
and recording
Okay,
also
sir.
I will send it, and we will
Okay,
meet
sir.
on Friday.
Okay, sir.
Okay then,
Thank you,
bye.
sir.
Thank you. Take care.
Bye.
Have a great day.
Bye, sir.
Bye.